Welcome back to the deep dive. Today, we're jumping into something that touches, well, pretty much everything in our global economy. We're talking about foreign currency exchange risk. How money flowing across borders can create these sometimes nerve-wracking situations for businesses. It's a really critical part of international finance, and it can seriously swing profits and losses. It affects big corporations, sure, but it can even trickle down to, well, our everyday lives. So, our mission today is to really unpack what drives these currency movements, why this risk exists, and how it actually hits businesses and maybe even you, the listener. But before we dive deeper, just a quick reminder this deep dive is based on material from Farhat lectures. All the content, the examples, the explanations we're discussing, it's all derived from the comprehensive accounting resources over at farhatlectures.com. So, whether you're an accounting student, maybe a CPA candidate, or already a professional, definitely visit the website. They've got additional practice questions, video lectures, and really detailed support to help reinforce everything we talk about today. A special thanks to Professor Farhat for providing this valuable material. Okay, so let's kick things off with the absolute basics. What exactly is foreign currency exchange risk? Is it really just about companies buying and selling things internationally?
Yeah, it fundamentally starts right there. Any company, any entity, even an individual really, faces this risk the moment they deal in a currency that isn't their home currency. So think about a U.S. company selling, say, widgets to customers in Europe. They might end up holding an account receivable money owed to them, but it's denominated in euros. Or, flip side, that same U.S. company might buy supplies from a European manufacturer. Now they've got an accounts payable, a bill they need to pay also in euros or another foreign currency. And the risk part, that's all about the volatility. The value of the euro or the yen or whatever currency, it doesn't just sit still. It fluctuates constantly. And these fluctuations, they can lead to unexpected gains, which is nice. But more often the worry is about unexpected losses for the company holding that foreign currency AR or AP. So the whole game for businesses really is finding ways to somehow reduce that risk, minimize it, or ideally even eliminate that potential exposure.
Okay, volatility. That makes sense. So we know what the risk is. But the big question is why? Why do these currencies move around so much? What are the hidden forces causing them to strengthen or weaken? Our source material points to two main categories of factors.
That's right. And understanding these two buckets, trade factors and financial factors, is really key to getting why currencies shift. They explain the sort of fundamental economic mechanics behind it all. Let's tackle trade factors first. The big one here is relative rate inflation. Simply put, when a country's currency has high inflation, its value tends to, well, decrease. People holding that currency see their purchasing power eroding, so they often try to convert it into more stable currencies. That action itself puts more downward pressure on the inflated currency. Yeah, the material uses a great example of the Turkish lira. If it starts losing significant value because of inflation, people holding lira might rush to exchange it for, say, US dollars. Why? They're trying to protect their wealth, maintain their purchasing power. It really highlights how, for businesses thinking globally, watching a country's inflation isn't just academic. It's a direct warning sign about potential currency losses down the line.
Okay, so high inflation generally pushes a currency's value down. What about the opposite? Like, if people in a country start earning more, does rising income automatically mean a stronger currency, or is it more complicated?
That's a good question. It's less about just being richer and more about what people do with that extra income. That brings us to the relative income factor. So if incomes rise across a country, people generally have more money to spend, right? Increased purchasing power. And often that means they buy more things, including more imported goods and services. This increased demand for foreign stuff naturally boosts the demand for foreign currency to pay for it, which in turn can influence exchange rates. And then, of course, there's the huge role of government policies and intervention. You can't ignore this. Think about monetary policy, what a country's central bank does. If a central bank decides to pump more money into this system, an expansionary policy, that generally increases the supply of the currency and leads to depreciation. It weakens. But if they do the opposite, a restrictive policy, maybe by buying back bonds to pull money out of the market, that tends to make the currency appreciate or strengthen. Fiscal policy, government spending, and taxes also plays a part, though the effects can be a bit more complex depending on the specifics. And beyond those big policies, governments can get quite hands-on. They might set a fixed exchange rate or subsidize certain products to affect trade flows. Sometimes they might deliberately weaken their currency to make exports cheaper and boost sales abroad, or strengthen it to make imports cheaper. Even things like trade barriers, tariffs, they reduce demand for foreign currency too.
Right, so you've got Trade flows, inflation, government actions. But what about just the sheer movement of money itself? Investment capital flying around the globe. Does that play a big role too?
Oh, absolutely, a huge role. And that leads us right into the financial factors. This is where investor decisions and how easily capital can cross borders really impact currency strength. A key financial factor is the interest rate. Generally speaking, if a country offers higher interest rates, it tends to attract more foreign investment. Investors worldwide are looking for better returns, so they move their money into that country, buying up its currency to invest. This increased demand pushes the currency's value up appreciation. Conversely, lower interest rates make a country less attractive for foreign capital, potentially leading to depreciation. And tied very closely to that is the ease of capital flow. If it's relatively easy to move money into and out of a country without a lot of red tape or restrictions, investors tend to see that currency as less risky, maybe even a safe haven. This ease of movement, this lower perceived risk, generally supports currency appreciation because, well, less risk is almost always better in the eyes of global investors.
Okay, this is fascinating, seeing how all these economic gears turn. But let's make it really concrete now. How does this actually play out for a business?
The material gives a good example with a company called Atom International Inc. So picture this. Atom International is based in the U.S. They buy raw materials from a supplier up in Canada. They've just made a purchase, and now they owe 1 million Canadian dollars. Payments due in 60 days. You can imagine Atom's finance team, right? They're looking at this 1 million CAD payable and thinking, okay, what's the Canadian dollar likely to do over the next 2 months? That's the risk. Exactly. Let's crunch some numbers based on the example. Let's say today, the spot rate, the exchange rate right now is $1 by his 1.35 Canadian dollars. If Adam could pay that bill today, it would cost them about 740,741 US dollars. That's just the 1 million Canadian dollars divided by the exchange rate of 1.35.
Okay, about 740K today. But they don't have to pay for 60 days. And Adam's big worry, according to the source, is what if the Canadian dollar gets stronger against the US dollar during that time? Let's say the forecast or their fear is that in 60 days, $1 will only buy 1.2 Canadian dollars.
Right. And if that fear comes true, if the rate moves to 1 USD equals 1.20 CAD, that same 1 million Canadian dollar payable suddenly costs Adam approximately 833,333 US dollars. That's the 1 million CAD divided by the new, less favorable rate of 1.20. Compare that to the $740,741 it would have cost today. That's a hit of over 92,000 US dollars, almost a 100 grand difference just because the exchange rate moved against them. It really hammers home how even seemingly small shifts in currency rates can have a massive six-figure impact on the bottom line. This isn't just theory, it's why companies really need active currency risk management. And of course, just to be complete, Atom would actually benefit if the Canadian dollar weakened. If the rate went to, say, 1 USD goes in 2.50 CAD, their payable would become cheaper in US dollar terms.
Wow, a $92,000 swing on $1 million payable. That's significant. It really shows the potential impact. So, for our listeners running businesses or involved in finance, what's the general rule here? Who fears what when it comes to importers versus exporters?
That's the core takeaway. Businesses sometimes underestimate how fast or how much these rates can move. So you need to know your specific exposure. Let's break it down. If you're an exporter, you sell things internationally, you likely have an accounts receivable in a foreign currency. That's an asset, right? Money coming to you. As an exporter, you want that asset to become more valuable. So your risk is that the foreign currency weakens before you get paid. You want the foreign currency to strengthen, to appreciate, so it converts into more of your home currency. Now flip it. If you're an importer, you buy things from abroad, like Atom Inc., you'll probably have an accounts payable in a foreign currency. That's a liability, money you owe. Your risk as an importer is the opposite. You fear the foreign currency strengthening. You actually want the foreign currency to weaken, to depreciate. Why? Because then you'll need less of your own home currency to buy the foreign currency needed to pay off that debt.
That distinction is so important. Okay, let's bring this right home now. Let's talk about our currency, the US dollar, especially relative to, say, a major partner like Europe and the euro. How does the dollar going up or down ripple through the economy?
Oh, the ripples are significant, absolutely. Let's take the first case. The US dollar appreciates, it gets stronger. For a U.S. company buying from Europe, that's good news for their accounts payable. Their dollars buy more euros, making imports cheaper. But it's bad news for U.S. exporters. Their goods suddenly look more expensive to European buyers, potentially hurting sales and making them less competitive. It also hurts U.S. firms with receivables in euros because those euros convert back into fewer dollars. And for consumers, a strong dollar makes foreign goods cheaper. And things like that, European vacation become much more affordable. Your dollar stretches further abroad. Okay, now what if the US dollar depreciates? It weakens. Well, now it's great for US exporters holding those foreign receivables. Their products become cheaper for European buyers, which can boost sales significantly. The research mentioned a perfect example. Remember 2008, 2010, after the financial crisis? The dollar weakened quite a bit. Suddenly, European tourists were flocking to places like New York City because their euros bought so many more dollars. It was a bargain for them. But the downside of a weak dollar hits U.S. importers with foreign payables. They need more dollars to pay those bills. And for U.S. consumers, foreign goods and travel abroad become more expensive.
Got it. Strong dollar helps importers and U.S. travelers, hurts exporters. Weak dollar helps exporters, hurts importers and U.S. travelers. So, knowing all this, let's try to apply it quickly, like in a real-world scenario or, a test question format.
Okay, sounds good. Let's use a question pulled from the source material. Imagine this. If a U.S. company has a net cash outflow, meaning they have an accounts payable in a foreign currency, which of the following outcomes would they want? Right, let's think through it. Net cash outflow as an accounts payable means they owe money. It's a liability denominated in a foreign currency. So what's their desired outcome for that foreign currency? If the foreign currency appreciates, strengthens, they'll need more U.S. dollars to buy it and pay the bill. That's bad, a loss. Therefore, the U.S. company would actually benefit from a drop in the value of the foreign currency. They want it to weaken, to depreciate. Because if the foreign currency gets cheaper, they spend fewer U.S. dollars to acquire it and settle that debt. Simple as that.
Yeah.
Their liability costs less than their home currency. That's a really key point for any business managing international payments.
Okay, wow. We really covered a lot of ground today, didn't we? From defining foreign exchange risk to digging into the trade and financial factors that drive it, like inflation, interest rates, government actions, and then seeing the real-world impact on exporters and importers, and even how the strength or weakness of the U.S. dollar itself plays out. It's clear these aren't just numbers on a screen. They have very real consequences for a company's financial health.
Absolutely. And while we've done a good job, I think, of identifying these risks and seeing how they manifest, understanding this is really just step one. The next crucial layer, especially for businesses operating globally, is figuring out how to actively manage that risk. How do you mitigate it? How do you reduce it? That often involves looking into specific financial tools, hedging instruments designed precisely for that purpose.
That's a perfect segue to a final thought for everyone listening. In a world that's just getting more and more interconnected, where global deals are the norm, think about this. How could understanding these sometimes subtle shifts in currency value give you an edge? Whether you're actually running a business, maybe just planning your next international trip, or even just aiming to be a more informed citizen watching the global economy. Recognizing these dynamics, it can genuinely change how you see things and empower your decisions. Definitely keep exploring this area. Maybe check out those additional resources we mentioned at farhatlectures.com. It's a truly fascinating and important topic. Thanks for joining us on the deep dive.